Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, August 18th, and I'm recording this from our studio in Purchase, New York. The S&P 500 has surged a remarkable 29% from its April lows. Alongside the rally, a bullish narrative has crystallized around headline-level data. Readings that suggest limited impact from tariffs on inflation, above-average economic growth, and better-than-expected earnings, especially among the Magnificent Seven. Add to this the improving odds of rate cuts and stimulative implications of the recently passed tax bill, and we have clear signs that market complacency may have set in, perhaps apt for the lazy days of late summer. But as we've said before, below the surface lies a much more complicated story, given market concentration and the skew in the economy between the haves and the have-nots. In recent years, the mega-cap tech companies have accounted for more than 50% of market returns. At the same time, the top 20% of households have accounted for more than half of all consumption. Observing this, we're less convinced that the bullish narrative is broadly applicable, and we see risks that must be considered for effective portfolio construction. Consider first the assumption that the entire S&P 500 will grow earnings by double digits for the rest of this year and all of next, thanks to expanding margins. Yes, second quarter earnings results did beat expectations, but a closer look actually shows that earnings growth was 26% for the Mag 7, but only 1% for the 493. That suggests margin compression for the majority. One explanation is that companies are absorbing the tariff tax, as indicated by producer prices, which have been rising faster than consumer prices. This also raises the question of how companies will actually deliver on these higher margin expectations. Will they pass on price increases to consumers, meaning inflation could step up? Or will they have to reduce their workforce, possibly hurting the consumer? What if they do both? Isn't that basically stagflationary? And finally, will AI adoption and productivity gains really drive 2026 margin expansion when, according to the census data, enterprise AI adoption is currently just 7%? Second, there's also this idea that we're entering a broad capital spending boom. But consider that capital spending in the United States has already been strong since the era of free money that began in 2010. That said, more recently, non-residential fixed investment has been growing more slowly than GDP and has also been concentrated around the Gen AI theme. Spending among the major hyperscalers, for instance, is over $300 billion per year. Investments in data center construction add another $40 billion. Critically, free cash flow growth has turned negative from these efforts, suggesting that the pressure to demonstrate return on this investment will only grow over time. On that point, the last time capital spending was this concentrated in a theme was during the shale revolution, when tech improvements led rapidly to overcapacity. Now, the analogy for AI is that the cost of inference is plummeting, while the cost of building faster training models is still rising. Whether we are on the path to potential excess capacity is anyone's guess, but increasingly the fate of the market index hinges on this issue. So considering all of this, we think selectivity still remains key. Investors should consider selling small caps, unprofitable tech, and popular but low-quality meme stocks. Look to add real assets like gold, REITs, energy infrastructure, and commodities while favoring active stock selection in U.S. large-cap quality names. Consider also intermediate duration investment-grade fixed income, including municipals, and international equities, including emerging markets. Rounding out our key recommendations are hedge funds and private secondaries, plus asset-backed lending and distressed investments in private credit. Thank you for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.